Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome back, Randy. It's fantastic to have you back on the podcast show.
Bilal, it's so great to be back with you. It seems like it's been a while and so much has happened. So I look forward to finding out, where we've been and where we're going.
Absolutely, yeah. There is a lot going on, and so perhaps we can start with that. Obviously, you're focused much more on the private side, private credit, and so on. But it's hard to ignore the macro background to everything, the backdrop. So, first, do you have a macro view to start with, and then how do you then map that onto private markets?
Yeah. Well, first of all, thanks again for having me on. It's you have an amazing enterprise, and to look at the scope and depth of your podcast guests that you have on and the work that you're doing is really incredible and top notch. So congrats on that. Just by way of introduction or reintroduction. So Randy Schwimmer, Vice Chairman of Churchill Asset Management. Myself and my co-founders, Ken Kinsell and Chris Cox, started the business. We're the remaining co-founders of the business. Our other founders have retired over the years, but we started the business back in 2006 as a private capital credit solutions provider for both investors and issuers, and we've really stuck to our guns over the last 20 years, and we are now owned by TIAA as our ultimate parent company, which is a multi-trillion-dollar asset manager. The actual money manager, if you will, is Nuveen, which is wholly owned by TIAA. And we are an affiliate of Nuveen dedicated to private capital solutions. With our European sister company, Arcmon, we represent about an $80 billion business focused primarily on financing for our borrowers and investing and managing investments for investors, a wide range of private capital products and solutions, mostly for middle market businesses, backed by private equity firms. And the macro, to some extent, is also something that we talk a lot about with our parent company, because they, as a $1.5 trillion business, are involved in a number of different strategies, both public and private, liquid and illiquid. They have about a $350 billion alts business. And so getting a lot of their signals about the impact on their various businesses, real estate, timberland, infrastructure, and so forth, has been very helpful for us. And what we look for is, in the economy, kind of what are the headwinds and tailwinds on businesses, particularly in the service-oriented sectors. We've noted over time, Bilal, that to prevent some of the cyclical winds that occur when you have up and down drafts with interest rates in the economy and so forth, that the service businesses, more free cash flow oriented, less CapEx, have been more successful, particularly in the credit business when it's all about minimizing losses. So we look at the macro climate.
And Randy, just as an example, what are some examples of sectors within services that have this free cash flow?
So business services in general, and these can be logistics businesses, anything that involves, moving boxes, for example, anything that involves commercialization of services. So, at a very micro level, commercial landscaping is a business in the middle market, which is a very robust business and survives a lot of cycles. We discovered that during COVID, when everybody went home and the offices were empty, but the owners of the office buildings had to keep the lights on, the lawns mowed, the sidewalks plowed, and so forth. And so we discovered that companies that manage those buildings actually are very stable from a revenue and cash flow perspective. And then, healthcare, technology, software, anything that tends to be less manufacturing focused, although we do some specialty manufacturing, but businesses that over time um, private equity firms, can invest in and not really worry about when they're going to exit. Basically, these companies do well through multiple cycles. And so the macro trends that everyone was worried about last year. So particularly in the beginning of 2024, when the Fed was sort of realized that, okay, I think at 5.5%, the benchmark is probably going to be, having some sort of impact eventually on the inflation, which was correct. They were right about that, and began to think about, in fact, having rates coming down. So here we are a year later, and in the beginning, certainly in January, the sense was a lot of the headwinds, such as interest rates, the economy, inflation, and so forth, had become pretty much tailwinds. The economy was still doing well. Inflation had come down, if not to their target of 2%, at least to a 2-ish% range. And labor markets continued to be pretty strong. The unemployment rate was still a kind of a pretty much of a low. And the worry before the new administration took office even was, tariffs and the geopolitical climate. And that was even for middle market companies, those types of things do have an impact. One of the reasons we like these smaller companies is that they tend not to be whipsawed by, issues with global trade, and so forth, or even, the geopolitical issues going on with Ukraine, or even the Middle East. But I think what you have seen now, and we're at the beginning of March when we tape this, that the public markets are reacting. Okay, they're starting to realize that this tariff thing could potentially be real, that it's a significant potential inhibitor to growth, which is why you saw public equities, do what they did in the last few days. It's now, I think, clear that, unless these tariffs get pulled back, and there's always that chance, right, that there is going to be some negative impact on the economy. That's the reason the markets are reacting the way they are. And so from a deal activity perspective, talking now about private capital in our business, particularly in the LBO business, so private equity companies being bought and sold, you've seen, and I think you probably commented in your broadcast about the global M&A trends since 2021 as interest rates have moved up. You've seen kind of global M&A going down. We began to see a bit of a restoration of that in the third quarter of last year, if you look at the global pipeline of deals. But it'll be interesting because while we experienced a record and are experiencing a record first quarter in terms of our deal flow, the pipeline for the second quarter is much lighter than we would have expected. And it seems as if in conversations with our peers in private capital that they're experiencing that same slowdown.
And is this related to the M&A private equity deals, or is this direct lending, or is it all of the above?
Well, it's we are experiencing it in the direct lending LBO business.
Okay.
And my guess is that the global M&A business will probably experience similar impact. It's hard to tell at the moment. And the reason is it comes down to simple, exit and entry prices, right? When you buy a company at a certain multiple, when interest rates were low, the ability to finance that same company when interest rates are high becomes more problematic. And so the multiples, just as you would, if you buy a house when mortgage rates are 2%, and now you're looking to sell it when mortgage rates are 7%, whoever the buyer is has to bear the burden of that unless they're a cash buyer. And so we're seeing that kind of hesitation. It was really interesting because the impact of that slowdown, of course, is that the LPs of the sponsors who have been financing through their fundraising these buyouts, since the M&A market has slowed, the realizations that these investors would have hoped to find as a result of the exits of these businesses has slowed as well. And I was reading today, I think it was in the Financial Times, Hugh MacArthur at Bain put it well. He said, the money, there's more money going into the cigar box than coming out of the cigar box. So, and from a fundraising perspective, everybody's trying to get money from the LPs, and the LPs are saying, hey, I haven't got my money back from the deals that, that you did a year or 2 or 3 years ago. So I think that cycle of realizations and fundraising and deployment has definitely slowed.
And in this sort of environment, or more generally, I mean, how do you go about sourcing deals? And companies like Churchill, obviously, you're very well established. What's your edge in terms of sourcing deals?
Yeah, well, we're very fortunate being an organization that has a significant amount of capital that we deploy directly as an investor, as an LP, into the GPs themselves. We have almost $20 billion that's allocated, committed to 300 different private equity firms and their funds. And we've been doing this for 15, almost 20 years now. And the advantage of that is that as an LP, as an investor, we're treated differently than you would be treated if you were just a credit provider, because credit is probably the ultimate commodity, Bilal, as you know. And so, you're out there saying, hey, we'll finance this company and we'll give you even cheaper pricing and even weaker terms. That's great for the borrower, not so great for the investor. And so one of the beauties of our model is that as an LP, we're seeing all the deal flow from these sponsors. They want us, we're in Fund 4 and we're Fund 8, and they want us to be in Fund 5 or Fund 9. So they continue to show us transactions, and we can be picky, without the sponsor being upset with us, because, they said, fine, you don't want to do the deal. That's great. We'll show it to someone else. And we do tend to be picky. So over 20 years, we've learned that it's not so much the deals you do that comprise your track record. It's the deals you don't do. It's the more risky ones that you avoid that tend to be a better reflection of your track record. And so we take that to heart. We probably turn down about 95% of the stuff that's coming in. And since the stuff that's coming in is coming from sponsors where we are already investor in their funds, that's a pretty high quality pipeline that we're seeing. And theoretically, we see about 1,000 deals a year. We could probably do all of them and probably have a pretty good track record. But some of these deals are more equity-like. They're higher growth. They may be in businesses that would be good for an equity investor. A startup or quasi-startup, which would have a high equity delta in terms of the buy-sell differential for the sponsor. But for a credit provider, all we're getting really is the interest and principal and a little bit of fee income. So at the end of the day, it's not so much being the first, second, or third horse that finishes the race, as one of my friends says. It's actually finishing the race at all. And we want to make sure that we finish the race and get our money back. So I think that's our differentiating feature. And then from a M&A perspective, and this is actually true across the board in the middle market and private credit, these sponsors work with smaller companies that they have identified through their partners or their operating partners. And the operating partners often are former CEOs or CFOs or entrepreneurs in the industry. So I mentioned commercial landscaping. So, an entrepreneur who has started a number of commercial landscaping companies, gets his money, retires, and then gets hired by the private equity sponsor to identify in a geographic region similar companies to the one that the entrepreneur started, and that he or she may have, in fact, relationships with those companies that they've built over the years, and has a credibility that the sponsor may not have in the industry, where they can reach out to those companies and say, hey, we've got a sponsor that's looking at consolidating the region of commercial landscapers, let's say in the Southeast, and can approach those companies. And if you think about all the hundreds of different types of niche industries in the middle market, and look at all these hundreds of companies, private equity sponsors who are looking in those niches for opportunities, what you have is an ecosystem that is a little bit detached from global M&A because it's been created in a way by these sponsors to develop opportunities in underserved markets. And so what we've discovered over time is even if the global M&A market seems a bit off because of interest rates or the economy or whatever, that there is some insulation in these smaller businesses to the overall macros because of these specialized opportunities that these sponsors, and each sponsor has a little different niche, where they, to I think the wording you used, the edge, they have an edge. So when you talk to the managing partner and say, we really like this industry because we have knowledge that nobody else has, and therefore we can extract value that someone else might not. And that, we think, in this direct lending middle market has provided some insulation over time. And so our pipeline continues overall to be pretty full, with the exception, as I said, of this pause that I think everyone is probably partaking in order to see what's going to happen next.
And one thing I have noticed is that there has been much more focus on private credit as an asset class in recent years. Not a week goes by where I don't hear of some new boutique being set up or something as people try to enter this market. So I'm just trying to think of the pressures on the sector. One pressure would be, why don't banks enter this space? I mean, more generally, obviously, there's a reason why private happened in the first place. Perhaps it was through regulation of banks, and so as bank capital withdrew, private sort of stepped in. But is there a chance banks come back into this space and just say, look, why leave it to the private credit guys? And then another question is, if there is more competition now, can you move up the chain? I mean, not middle market, but the larger market, just move up, further. So how do you think about those two factors?
So I'm not surprised that you have, within 5 minutes, 10 minutes, have identified the critical issue about our industry. So my history before Churchill was in banking. I was at JP Morgan for 15 years. I was responsible for what was then the middle market and the trading, the syndicated loan business in that sector. Now it's called private credit. And in those days, going back, early 80s and early 90s, particularly, the banks owned the leveraged loan market. There was really no such thing as private credit. Yes, there were some middle market practitioners. There were some finance companies, Heller Financial, GE Capital, others that did practice in the smaller space. But over time, what happened was, as the banks consolidated, because JP Morgan Chase now is a composition of many banks, Chase Manhattan, the Chemical Bank, Manufacturers Hanover, Bank One. I mean, there's a lot of banks that, were gobbled up to create JP. And they became less interested in these smaller companies. The Fed and the OCC was saying, you know what, we don't really like you holding these leveraged loans because they're risky, and therefore we're going to charge you more capital for this. And so the banks realized, I'm much better off, instead of holding these loans, just selling these loans. And so they created these trading businesses that were designed to just, get fee income and not hold the loans at all. So from a capital perspective, it made a lot of sense. But what happened over time, in 08, 09 was a perfect example, Bilal, where the markets became disruptive and then there were no buyers. And yet the private equity sponsors had deals to be done. And so they were coming to Churchill, the Churchills of the world, saying, my bank has basically stopped lending. I need your help. And so over time, certainly energized and motivated by the Great Recession, it became obvious that having a long-term balance sheet, long-term liabilities to match the long-term assets of these loans without having depositors at risk, all right, that, to take it out of that regulatory framework into a more asset management framework made a lot of sense. And in that from 2009 to 10, really up through the present, this development of a new asset class, which really isn't new. Middle market lending has been going on for 1,000 years, but in its new guise as an asset class that it turned out to be more resilient than anyone had thought. When I was growing up in the business, everybody thought that smaller deals were more risky, that middle market defaults and losses were going to be way worse than large liquid companies, which, on the surface made sense. These are big companies. They have scale. They can go public. They can issue bonds. But when you started to dig into the details, what I discovered pretty early on was that actually, when it came to defaults and losses, the dynamics of what was going on in the liquid loan market were actually worse for investors, because what would happen in a troubled situation is, if you didn't trade out of that sooner than the visibility of the problems became evident, you were kind of stuck with a loan that traded well below par, which was your entry point. And then you would attract funds who, if they bought in at 60 cents on the dollar, were happy to get out at 70. But if you had come in at par, you weren't happy to get in at 70. And so the dynamics of those lender relationships actually created more problems on average for the BSL market. And if you look historically over time, the default rates and loss rates for large cap loans in general were worse than for the middle market. And as people started to realize that the fact that the illiquidity of private credit, which historically was thought to be a negative, if you are holding the assets for as long as you need to see that value get back to par, and if the other lenders in the lender group that you're with are of a like mind, you can actually get your money out for the most part at the end of that period. And so that discovery, is like Newton watching the apple drop on his head. The law that illiquidity does not mean bad credit, but actually means more stable valuations, created this wave that started almost 20 years ago and is, not showing no signs of reversing. And so what we're seeing, to answer your question, is that the banks, while they came back in the market last year because of the Fed's change of direction and the realization by CLO investors, and CLOs, these are collateralized loan obligations, structured vehicles that are designed to hold these loans, that the equity arbitrage now with lower interest rates worked, and so CLO volume picked up. The broadly syndicated market, literally January 1st of last year, turned on and had a record year. But the secret is that 95% of the deals they did were refinancings and repricing. So they kind of were unable to get back into the LBO market for the most part, and that, as private credit market has expanded, has that field has really been left to us. And I think then, to answer your question about the large cap, what we've discovered in our business is that the middle market is probably the best place to be from an investor perspective, because as you go up into the larger market, the largest of the asset managers need to sharpen their pencils. As the larger asset managers go up market, they realize in order to keep the private equity sponsor from actually going to a bank, they have to be competitive in terms of pricing, which means narrower spreads, and also covenants, which in the case of large cap deals means, for the most part, covenant light transactions, which is a fancy way of saying, bond-like covenants. These are covenants, financial tests that, as opposed to being measured at any time, are only measured if you incur more debt. Well, if you don't incur any debt, then they never get measured. So you could theoretically have infinite leverage. As long as you're still paying your interest payments, nothing happens. Those kinds of structures, for us anyway, are not as all-weather, and therefore we tend to like the more conservative end of the market, which has financial tests, lower leverage, and so forth. So we're fine where we are, and we expect that, even though I'm not saying, Bilal, that if the bank market goes away, if we have a recession, bank market goes away, we will get the calls on the larger deals, and we'll say, look, here's how we'd like to structure it if you'd like our money. That's how
Okay.
that's
So there is something different about the larger market. It's not just
yeah.
middle market, but bigger. But there's something fundamentally different. It's
Yeah,
covenant structure is different. The banks,
yeah.
the spreads, everything just changes.
It's the deep end of the pool,
Yeah.
and we find the swimming just fine in the regular lanes.
Now you mentioned default rates and such, and some, at least on the macro level, you are seeing increasing default rates, delinquency rates in certain sectors, if not sort of generally picking up. Are you seeing that at the sort of the micro level as well?
No, and I'll give you that's I mentioned the macro historically on default rates, where because of this dynamic in the liquid versus illiquid markets, that the middle market has proven to be easier to deal with in order to get your money back. The current environment is such that there were expectations a year ago, and a lot of media print and some investment bank research teams who frankly were not necessarily involved in private credit, particularly some of the big banks who came out with reports saying that there was all this default's going to happen, waiting to happen. You've read this, I'm sure. And usually when you read the article, it's somebody who doesn't have experience in the space. And like I said, on the face of it, one would understand, small companies, they're going to be more vulnerable. There's also a perception, Bilal, that because these are private businesses, private companies, and that the loans don't trade, that if you can't see the business on a ticker, on a Bloomberg, that it must be bad. The value must be questionable. But in fact, the value is not only something that we as investors are focusing on, every day, and looking at the performance of these businesses and rating them depending on how they're performing relative to budget on a monthly basis. But they're also being tracked by third-party valuation firms that we hire in order to give our investors comfort that it's not just Churchill saying this, but we've got some major valuation firms in there, going through our portfolio name by name. The sector issues, I think, that we have seen just in our own portfolio under pressure, just to name a couple examples. I think technology, not so much in terms of operating performance, but in terms of competitive pressures. And we've seen this in the large cap public markets, right? So even a firm like NVIDIA, which is like the darling of the Magnificent Seven, there's issues when a new entrant comes in. It's like, whoa, how are they going to compete with NVIDIA? Now it looks like, NVIDIA's going to be fine. Thank you very much. But you go down the food chain in technology, the speed of evolution of advancement is such that with certain businesses, you really don't know, will someone come in and invent a better mousetrap? And so what we have done at Churchill is just focus on more enterprise-focused, business service-oriented technology that is ingrained and built into, for example, part of the production of the business that focuses on improvement and efficiencies, and technology is employed there to reduce costs. And those types of quote tech businesses tend to be in the lower tech end, and with businesses, smaller businesses, where that particular company, that service provider, has been doing business for many years and is ingrained and embedded in the infrastructure of those companies, or service companies that, for example, one of the subsectors we like right now is measuring efficiencies. So if you have a production business that is providing production line calculations and analysis to make sure that the product is being going through the pipeline process in a way that reduces costs and creates, better profitability. Those kinds of companies right now, in the face of potential softening in the economy, are getting a lot of attention.
So in some senses, you're staying away from sort of the glamorous, high tech,
Correct.
fast moving sort of side, which takes all the headlines, and instead moving
Yes.
in the areas where it's tech, but it's entrenched in processes, longer procurement processes. They've got good relationships, so it's inherently more stable.
Correct. And so, but it is something that we're now alert to. And I would say, obviously, government contracting businesses, just given the new administration's focus, that's something that is, and we've not been necessarily big lenders in that space anyway, but it's further evidence of why that's always a bit of a challenge space, because you never know with the change of administration what's going to happen. And then the last area, which is of interest, is healthcare. It's been one of our historic largest sectors over the last 20 years, basically because it's such a big part of the economy, but also because when you just say healthcare per se, it's health. There's no such thing. There's really dozens of subsectors within healthcare. We tend to not focus on the, for example, hospitals and the more direct service providers, as opposed to areas that are related to that. So, for example, historically, we've done a lot of physician specialty practices that spin off from hospitals, and going back several decades, the growth of dental practices that are set up, or the growth of surgical practices. That has become a little more problematic as that space becomes more crowded, and particularly as the doctors are owning these businesses in large part, along with the private equity sponsors. You want to make sure that the physicians feel like, okay, the value of the business is there. Otherwise, why am I doing this? I could be just working for a hospital and making a good living. And so some of the risks, particularly in businesses where cost reimbursement, we're seeing coming down, is an issue. Those are parts of healthcare that we're being cautious on. But in general, the expectation of widespread defaults as a result of high interest rates was the call from a lot of these research firms, again, who were not necessarily as plugged in as others, never really materialized. And in fact, default rates amongst the direct lending deals actually significantly below where people thought they were going to end up. I think KBRA is now saying something like, I think it's less than 2% default rate ending up for 2024, compared to an over a 5% default rate for the BSL market.
I mean, why do you think that is? I mean, why? I mean, interest rates went up dramatically, and
Yeah.
as you said, certain banks were sort of like going out, and newspapers were saying credit going to blow up, and it just didn't happen. Why do you think that is?
So the direct lending managers now, including us, obviously, have been around long enough and seen so much variability in the macro environment since 2008, and even before the recession, that they have a playbook. We have a playbook. They have a playbook. A lot of the experienced lenders. I'm not saying that some of the inexperienced new lenders aren't going to have issues, but for those of us who've been around a while, when we look at a deal, we look at it and we say, all right, it's great now. This is what we did from 2010 to 2022. It's great now. The LIBOR and then SOFR is 0%. Fed funds rate is 0%. So we could potentially leverage the business 4, 5, 6 times, whatever. But what happens if interest rates go up? And so we model, and we've been modeling much higher interest rates in the projections that we do to look at how this company would behave. And then we look at how the company did during the recession. And we take that performance, let's just throw out 20% revenue cut, 20% cash flow cut. And we model a recession within 18 months, 12 to 18 months of the time we do the deal. So if we do a deal today, by the summer of 2026, we assume that the company is going to be in recession. And then we look at the pro forma cash flows and say, okay, can this company weather that and still pay their interest back? And if not, then it's not a deal we do. So what happened was, when interest rates went up, our portfolio was already designed to withstand the hurricane force of the winds. You know what I'm saying? And we were fine. And, the issues that we had, yes, the interest cushion definitely was compressed. So, Bilal, in 2021, we didn't really even measure our interest cushion on the portfolio because it was like four or 5x, because interest rates were so low. And then as interest rates went up, investors were asking, well, okay, well, what's the interest expense cushion on your portfolio? And I'd be in a meeting and I would text my head of senior lending and I would say, I haven't seen this number recently. What is it? And, it went from like 5 times to 3 or 2.5, right? So it definitely was compressed. But then what happened was, as the hurricane of high rates hit us full impact, it never got below the 2x. We still had a 2 times cushion in general on that portfolio. And my sense is that the other experienced direct lending community who've been through this before had similar experience. And even frankly, if there were certain companies that did worse than the 2x, private equity sponsors would work with the lenders to come up with a amended debt structure. And maybe it meant lower interest burden for a time. Maybe it meant less cash interest and more PIK interest. Maybe it meant suspending it for a couple quarters altogether until the company got its act together. But then over time, the private equity sponsor would work with us to say, okay, now company's doing better. Interest rates, we think have topped out. We're good to go. And so when you look at the portfolios overall in the direct lending market, you've seen experienced managers deploy this playbook successfully and are now in a position where, we're holding tight and seeing what's going to happen next.
That's great. Now, we touched on tech earlier, and I wanted to just speak about AI. Are you finding AI is being used by your portfolio companies? Are you using AI in some way? Because that's really been one of the big question marks on AI. There's a lot of hype around it all, but are there any use cases or not?
Yeah, the answer is that it comes up frequently at our investor conferences. So we hold an annual conference every year, and we have, I think, a panel that's been talking about this, and I talk about it whenever I'm sitting down, with a private equity sponsor and asking them, because I get questioned by people like you who are smart in this space. And the answer is that AI has been used for a while by private equity sponsors in their businesses. It's sometimes not called that, but to give you an example, I think the calculations, the rapid calculations with complex and complicated variables that require timely analysis, that's an area. So, for example, I mentioned measuring and metric-oriented types of service companies, that the sophistication of those calculations as enhanced by AI has really been the driver for a lot of the applications that private equity sponsors are using for things like manufacturing and even in the service technology areas where there's a need to take an enormous amount of complicated data and quickly synthesize and analyze it to produce results and answers that help not just their clients, but frankly, the product developers at these companies, just perform these tasks more quickly, more effectively. And that part of AI has been growing for a long period of time. It's happening as kind of a ongoing and integrated part of the product and service development of these businesses. And frankly, it's very exciting because when you watch it going on, and we ourselves in our own portfolio now, as an example. So think about, I mentioned we look at 1,000 deals. We do about 50, 60, 70 new deals a year, but we do refinancings, add-ons. So, we have let's say a portfolio of 300 companies, about $25, $28 billion. But I mentioned we only do 5% of the stuff that comes in. But we're an investor in private equity funds that translate to, and I'm giving a rough number, but let's say 3,000 companies, so 10 times the number of companies that we're getting information from. We're starting at Churchill to think about ways that we can analyze that data that's coming in from all these LP investments that we have with funds and all of the portfolio information from those private equity owned businesses to tell us something about the sectors that they're operating in ways that 5, 10 years ago wouldn't be possible. We're still at the beginning stages of that. We've done some work. We're super excited about the impact in our own investing and thinking about more information you get on some of these niche businesses and how they're doing, even if, frankly, you're not a lender to one of these companies. But getting that micro information on how those companies are performing is really going to, I think, set the stage for some really evolutionary work for portfolio management. And that, I think, for us is the most exciting application of AI right now.
And I know you predominantly focus on the US, but do you have any views on private markets or private credit elsewhere around the world?
Yeah.
Europe, Asia?
So we have, our investors are kind of a third. So US, we'll call it North America, Europe, Asia. So we're spread out pretty widely. I'm actually headed to Australia on Friday for a week there with our clients. In my new role as heading up our investor solutions group, the work that we do in meeting with clients globally is really interesting for me because being also on an investment committee and then also publishing our Lead Left a podcast and a newsletter every week, the thing that I find fascinating is when I sit down with European and Asian investors, there is a commonality to their view on private capital. And the commonality is that they have already made the decision, Bilal, that private capital needs to be a part of their portfolio. Often it is part of this alternatives category, which includes real estate, private equity, and others. But particularly with private credit, the stability and durability of returns and performance through various cycles has demonstrated now over almost 20 years to these investors that we need to be in this in order to complement the public and liquid part of our portfolios. They saw the damage that the interest rate change in the ecosystem did to fixed income and public equities in 2022. And they're like, I don't want to repeat that again. I need a stabilizer. It's that, I use the metaphor of the camera that the steady cam, I think they call it in movie making, where the camera person is running on uneven ground and yet the camera, the picture is steady. Private credit is the steady cam of the capital markets. It's the stabilizer of the picture that allows investors to maybe not get 20+% returns for private credit, but for, in this environment, kind of 10 to 12% returns that will be stable as long as the benchmark is at that level. And then if the benchmark comes down, yes, rates will come down, our yields will come down, returns will come down, but so does everything else. And so the relative value still remains the same. And what our European and Asian investors now are fully invested in is that concept of the stability and performance from an income perspective, whether it's high rates or low rates, whether it's high growth in the economy or low growth, whether it's higher inflation or lower inflation, stability of those returns remains. And even though Europe and Asia are behind North America in terms of the development of the market, their following of the pattern of investing in the U.S. is very similar. And I find it, in fact, very rewarding to be in these markets where they may feel like they're a little behind the curve, but they're catching up quickly.
I mean, do you think there'll ever be, or is this already happening, where from an asset allocation perspective, private credit moves outside of alternatives and becomes its own individual bucket? So you have public bonds, public equities, private credit, private equity, and then alts is kind of.
Yeah. So I was telling the story at a conference a couple of weeks ago about, and it was a question that was related to that, that when private credits started, it's almost like a teenager that is trying to move out of their house, and they move in with friends. And so, in some cases they're living with, a bunch of people in their apartment. So it's like private credit didn't have, when it was starting off, they weren't able to get their own apartments. So private credit was in the, let's say they were in the real estate bucket, believe it or not, or they were in the private equity bucket, or they were in, believe it or not, in one case, they were in a hedge fund bucket. One of our investors said, oh yeah, we group up with the hedge funds. As the teenager has grown up, they get their own apartment. And your question is, are they going to have, is it going to be, I think private capital is probably the grouping that will end up being the most popular. We ourselves think of it that way, even though private equity is different in terms of, the levers that move that asset class. Again, it's not debt, it's equity. So there's different things that affect the performance of it, and obviously different risk return variables. But I think private credit now is firmly established in its own category. Private markets is a good way to think of it for the investors that we talk to. And I think the growing sophistication by these investors, both institutionally and I think in the next wave of growth, which will be in the retail and wealth channels, I think understanding that, private and illiquid doesn't mean anything less valuable than public and liquid. And in some cases, they have learned that being liquid isn't necessarily the best thing when you have the kind of headline risks that we have been witnessing over the last several years.
And just to round off, I know you're very focused on risk and so on. So, I mean, what are your main worries for 2025 for the rest of the year?
Well, I think this issue of tariffs, as we started this conversation on, and geopolitical risks, is definitely top of mind for our investors, particularly given the uncertainty, Bilal, related to that. I mean, with interest rates last year and going actually back to 2022, as an example, when the Fed was seemingly slow to get the joke about transitional inflation versus, this is permanent, they did catch up, and they did actually execute a soft landing last year. They slowed inflation down without slowing the economy. Unfortunately, the Fed really doesn't have any control over tariffs and the geopolitical issues. And in fact, the institutional framework related to those two areas, it seems to be very different than anything certainly I've experienced in my lifetime. And so what I think the business community typically looks for in the conversations I've had with them is, bad news is better than uncertainty. They don't mind, like, okay, if I'm going to sell a business in Canada and I know I have to factor in a 20 or 30% tariff or whatever it is, okay, fine. At least I know exactly what it is and I can work around that. Business people are really good at adjusting to the realities of the economy and the markets. But if I'm not sure, if I don't know what it is, how can I plan for it? And that's why a little bit of this pencils down approach seems to be the case in the markets. We hope that will be temporary. And then once the tariff and geopolitical uncertainty becomes resolved, that we'll have a really good second half. I actually believe that will be the case. I do believe that people are telling me that, the current environment, in what's going on, in the world is probably a result of some gamesmanship, trying to get the best deal that's possible. And once the deal is settled, then we can move on. That's the hope. I think, we'll see what happens. My guess is that the administration probably doesn't want to see markets, tank. They prefer good, strong economy, good markets to be solid. They want to get extract as much value as they can, which is why I think we're seeing some of this going on. But hope is that second half of the year will be more productive. The thing that is probably our focus on our investment committee is deal by deal, right? We live and breathe credit. Our committee, our investment committee has been together for 20 years. We've approved every deal we've done. We worry, okay, is this deal going to be the one that's going to get us into trouble? And so we're super picky and super careful about what's the impact of macro things going on in the world right now to this company, and then what's going on with the micro. What about the world that this particular smaller company occupies is going to change, whether it's competitive or whether it's global issues, which tend to be more North America focused. What about the structure of the deal that we're looking at could potentially impact our performance and our ability to return all our capital to our investors with a return. Those are probably the things that right now we focus on more. It's sticking to our knitting, making sure we do good deals, don't do bad deals, and think about the world from an investor perspective. We are all investors. We own equity in our business. We own, we buy, we have money and our own money invested in every fund we do. And by the way, our parent company invests alongside us in every transaction we do. So when you have a AAA parent company alongside you, it's real relief. But you also, you want to keep the trust and do good deals. So that's probably the thing that's going to continue to keep me up at night.
Yeah, that's fantastic. So just finally, what's the best way for people to learn more about Churchill, also follow your work as well?
Sure. So The Lead Left is our weekly newsletter that we send out free to investors and friends of Churchill and friends of Bilal. I'm going to extend that offer, special offer. Friends of Bilal, all you have to do is mention the Hive podcast with Bilal, and you'll get a free subscription. It comes out every week. I've been doing it, Bilal, since March of 2008. Goes out to about 50,000 subscribers. And then we do a podcast. It's not quite as robust and professional as yours. We call it the Private Capital Call. We need to have you on that as well. I think that'd be a fun interview. And you can see that on LinkedIn. And so either the Lead Left or the Private Capital Call, and I'm all over the place. So I'm sure you can just hook up with Randy Schwimmer on LinkedIn, and we'll get back to you.
That's great. I'll make sure to add those links to the show notes. So with that, thanks a lot. Really informative discussion as always, and good luck with your upcoming travels all the way up to Australia.
Thank you, Bilal. It's an honor and a pleasure to be with you, and best of luck with everything you do. You do a great service for investors everywhere, and keep doing what you're doing.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.